All right, hello everybody, this is Mike Rixey. I am the lead options instructor for Netpicks. And in this video, I want to highlight one of our recent trades that we've closed out because it addresses perfectly one of the top questions that I've been getting over the last number of weeks. If you've been active in this market here recently, you know it's been a very difficult environment. We've had a lot of big movement intraday, but it has not led to any type of trending move. We get these moves for a couple of hours, maybe 24 hours at a time, and that's it. It doesn't move into day 2, 3, 4, 5. And when that happens, it can be a struggle depending on the strategies that you're using. If all you've been doing is buying long calls and long puts here the last few weeks, you probably found it pretty difficult. I've heard from many traders that have been struggling trying to generate income in this market because there hasn't been a lot of follow through to work with. Well, what I've been highlighting in our recent Trade of the Week series is expanding your playbook out. Introducing some other types of strategies that are perfect for generating income in an indecisive market. We know markets will pick up. We know we'll get more trending type moves here in the near future. But while this market is just kind of bouncing back and forth, what can be done to generate some income? Well, I want to highlight a trade here on Pinterest. It's a perfect example of what can be done to make some nice money without a big directional move in your favor. So this is symbol PINS. This chart is the chart that we used to generate the signal here a number of weeks back. We actually initiated this trade at the beginning of August, and I highlighted that with the red arrow here. This is back on August 2. At the time of that trade, we were looking for a neutral to bearish type position. At that point in time, Pinterest had already made a really nice move to the upside. We were getting towards overbought conditions, and what I was looking for is either a period of consolidation or a pullback. Now, normally if you think, I want to buy a bearish position on, you're thinking buying long puts. The problem that I have with buying long put options is they only make money if that stock makes a big move lower, and it does so quickly. If it takes too long, if the move's not big enough, you're going to get crushed by the time decay. And that's why so many people struggle to generate consistent growth in their equity curve. What we decided to do on this position, instead of buying long puts, we came in and we sold a call spread. And I'll show you the trade here in just a second. The whole idea here is I still want to position myself bearish, but I want to give myself multiple ways of making money on the trade. I'm going to give up the home run profit potential in exchange for a higher winning percentage. And let me show you what happened here in just a second. So let me jump over to the trade page and switch this to Pinterest. What we did on Pinterest is we came in and we sold the 37.40 call spread in the September monthly options. So what that had me doing, let me go ahead and queue up the trade down at the bottom. We sold the 37 call and then we bought the 40 call at the same time to make it a risk-defined trade. A lot of times people get intimidated by credit spreads because they think, man, if I'm wrong on the trade, I'm going to lose my shirt. It's actually not the case. By selling this $3 wide call spread, it took up just over $200 of capital. That was the most I could lose on the trade. If I was dead wrong, I was out $200. When you compare that to buying an outright call or a put, well, if I buy a call or a put, depending on my expiration cycle, depending on my strike price, you're potentially talking about $400 or $500 per contract. So this was a much more cost-effective trade, but even more than that, it gave me multiple ways of making money on the position. Let me just for a brief moment change the price here so you can see what I was talking about. We collected 80 cents. $80 per spread to put this trade on. So here you can see it. We collected $80. We are risking $220. Now, why does that make sense? We're typically looking to risk between 2 and 3 to make 1. And the reason I am okay with that is I've got 5 ways of making money on this position. I just need price to stay below 37.80. You can see that break-even point right there in the order confirmation box. That number is calculated by taking the short strike, the 37 call that I'm selling, and we're adding on the 80-cent credit that I collected to put the trade on. I don't care if the stock moves up, down, or sideways. As long as it doesn't go above 37.80, I can make money. Now, how is that the case? How do I make money on this? I make money from the time decay adding up and from volatility decreasing. We all know that when you trade options, it's like holding a ticking time bomb. If you buy an option, you need that move to happen relatively quickly. Well, by selling a spread here, by collecting premium up front, we flip that whole thing around. Now time decay is helping me. Every day that passes, that allows me to make more money on this position. If the volatility decreases, it also causes the options to get cheaper. When you use a credit spread like this, the whole goal is for this trade to get as cheap as possible So it either expires worthless or I can buy it back much cheaper. Okay, so the only move that was going to hurt me here was a big move higher, which I was not expecting because Pinterest was already overbought. I wanted to lean bearish anyway. So now I give myself 5 ways of making money on the position. It's a risk-defined trade. I know what my maximum loss is right up front. That allows me to use proper position sizing, get into a position that I feel comfortable with based on my account size. And here's what happened. Let me go ahead and go back over to the chart here real quick. Since I put the trade on, it was kind of a messy pattern here, right? Along with the rest of the market. We saw moves higher, lower, higher, lower. We're just kind of bouncing sideways. And then just over the past couple of days, we finally got a move to the downside. When we initiated this trade, the stock was around 33.5, between 33.5 and $34. It's now down at 30. So did we get a huge move lower? No, it wasn't a huge move, but we didn't need it. Is this the type of home run chart pattern that you see a lot of people posting online? It's not. It's just a lot of back and forth, a lot of chop in here, right? But yet we were able to close this trade out here today. Let me go ahead and change the price. You can see it's trading for 5 cents. You can close this thing out for 5 cents, book around a $75 profit per spread from that messy looking chart pattern. Now, am I telling you to trade credit spreads exclusively? No, you don't need to. It's just one tool in your toolbox. If I look at my own personal portfolio, I've got some long calls and long puts on right now. I've got some debit spreads. I've got some credit spreads. And by mixing those trade types, that's why I'm able to generate a consistent source of income. I can't tell you how many traders I hear from on a regular basis that say, Mike, I'm only trading long calls, long puts. That's all I want to do. I want to be ultra conservative. When in reality, what they don't realize is that's the most aggressive route you can take. Those are going to be trades that have the lowest winning percentage. That it's fine if it's just part of your overall trading. But when you start to combine that with some of these vertical spreads, in this case a credit spread, that's when you're going to see the power kick in. That's when you're going to take full advantage of options. If you have not traded spreads in the past, we would love to help you out. Send me an email. Mike@netpicks.com is the email address. I'd love to answer any questions you might have and walk you through some steps that I believe you need to follow to become successful long term. So really nice $75 profit here. Again, we made money from this choppy chart pattern. This is what gets me excited. I love to have those home run trades from the long calls, long puts when they happen. That's a small part of my overall portfolio. But this chart gets me more excited because when I start to see that I can make a $75 return off of tying up $200 of capital in a sideways, choppy market, that's what gets me excited because now I know I don't need the big market moves. I'm going to have the flexibility to react to whatever the market throws my way. And again, you don't need a ton of capital to do this. Is it realistic for many of you to tie up $200 of capital to put on a position? Yes, absolutely it is. And I say that because I talk to many of you on a regular basis that have that $5,000 to $10,000 account. It's a very typical starting point. Well, this is a very realistic trade. Sometimes it's not realistic to buy a long call or long put. If you've got a $5,000 account, you don't want to spend $500 to $1,000 buying a long call or long put. But it is realistic to tie up a couple $100 on a vertical spread, especially when it gives you 5 ways of making money on the trade. So I'm going to go ahead and wrap this video up here. Again, if you have any questions, feel free to post a comment here on this video or email me directly. My email is mike@netpicks.com. So enjoy the rest of your week, everybody, and I'll be back with you shortly with our next video.